Welcome to another exciting edition of the Trading Bell. This week on the program, we shall be talking matters banking, and I'll be having a renowned analyst and also the country strategy director for Absa here in Kenya. That is Mr. Moses Muthui. He'll be explaining to us how the markets have been performing under the pandemic, and we'll also be taking a deep dive in how the economy will look like come 2021. Before we get into that interview, let's take a look at Muthui's profile. Moses Muthui has 15 years experience in banking, gained both locally and internationally, having previously worked for Barclays Group in London and Barclays Capital, the investment banking arm of Barclays on Wall Street, New York. Moses is currently a director at Absa Bank Kenya PLC, responsible for country strategy, country investor relations, and finance for the corporate and investment banking division. In addition to his executive responsibilities at the bank, Moses serves as the Absa Asset Management Limited as an executive director and the chief financial officer, and sits on the board of the Nairobi Securities Limited and as an alternate executive director. He holds a bachelor's degree in economics and mathematics from Egerton University, a master's in finance degree from the University of Nairobi, a master's degree from the London School of Economics, and a senior executive program qualification from the Harvard Business School. Thank you so much for making time for us, and as we close off the year, let me say Happy New Year and Merry Christmas in advance.
Thank you, Abby. Always a pleasure to talk to you. The year has gone really fast. I hope you enjoy your holidays as well.
I will. I'll try my best, even if the economic times continue to change. And Moses, looking at our recent data, we see a lot of inferences that are coming in, especially when it comes to economic growth forecasts. They've been revised severally over this pandemic period. We've seen job losses standing at about 1.7 million Kenyans being affected, and generally the economy seems to be on its knees. From your viewpoint, how have we managed through this pandemic as a country, as an economy?
Thanks, Abby. I think it's a very topical discussion to have. Clearly, we are facing the most defining medical crisis of our time. An economic crisis, a medical crisis that created a sudden economic stop, with the lockdowns. And with that came extraordinary contraction of the economy in the last 3 quarters. Mm-hmm. I recall, it's like a tale of two cities. In Q1 of this year, GDP was up 5% plus. That has been fully watered down by the contraction we've seen in Q2 and Q3, with severe dislocation in sectors like, tourism and hospitality. Really, unwinding the gains we've seen in some sectors like domestic consumption and domestic agriculture.
Sure.
By one calculation, 9 out of 10 businesses that were started Q4 of 2019 and Q1 of 2020 have failed. Yeah. That's really a severe dislocation of what we're seeing in the market. You're rightly correct that 1.7 million people were meaningfully employed Q1 of this year. Yeah. They're now out of jobs. And so we are seeing this, severe economic dislocation as a result of the COVID crisis, not just here in Kenya and globally. I think as we look into the future, I think the uncertainty continues. Mm-hmm. There's likely to be some technical recovery going into next year. From a low base of Q4, you may see some shoots of growth. Mm-hmm. But I think fundamentally the economy will continue to remain challenged for a foreseeable period. Some people talk about some recovery in the H2 of next year, but fundamentally, mindful of the fact that in less than 2 years' time, off the heels of COVID, we have an election year, and elections always tend to hive off, 100 to 200 basis points of GDP growth. Yeah. So I think, elevated uncertainty remains. I think we'll see some recovery in some sectors. I think it will be a long journey to full recovery to pre-COVID levels. But what we like is what we've seen as a response to the economic contraction that we've seen. You've obviously seen some enormous physical support from the government, with tax reliefs, direct injection of cash into the economy. Yeah. We've also seen very concerted monetary policy easing globally as well as here in Kenya. And on the banking sector side, you've seen banks extend loan restructures to a tune of 1.2 trillion. At Absa, we've extended payment holidays for 62 billion shillings, 30% of our balance sheet. As you have these enormous forces colliding, and how the economy recovers as a result of these interventions, is something we have to wait and watch and see.
Interesting. And speaking about the uncertainty that continues to linger over Kenya's economy, perhaps looking at the interventions that have been coming through from central banks across Africa, across the world, there seems to be a common theme where central banks are simply trying to see how best can we cushion the borrowers at the end of the day. And we did see a number of interventions here in Kenya. For instance, we did see the central bank suspending the listing of defaulters under this CRB. We also saw central bank actually bringing down the benchmark lending rate. And all this is somewhat geared towards shielding the small businesses, the corporates from further shocks that had already permeated through the various layers of the economy.
Yeah, I think the actions by central banks globally have been remarkable, and in my view is that the right actions have been put in place. Clearly, as an economic enterprise, as financial services players in the market, our businesses can only be sustainable if we reduce or avoid consumer and borrowers' distress. That's really fundamental. We've got to shift the power of decision making slightly away from the shareholders towards the consumer and the borrowers, and towards the common monaigi. Unless we find our way out of this together, it's very difficult to have sustainable businesses. So absolutely the right actions to make sure that there's easing on the monetary policy side, the right actions by banks to come into onto the table and extend payment holidays and restructure loans. These have been very well timed and I think impactful actions. I think one can always imagine of the storm that is gathering out there, because these payment holidays have maturities. What if the economy doesn't recover as fast as anticipated? Do we go on cycles of payment reliefs? At what point do we begin as banks to lend directly to the economy, even with some of the weaknesses that we are seeing? At Absa, we've lent about 70 billion shillings this year, gross lending into the market. In these circumstances, most of that money has gone into small businesses. But I think there's something here we just have to be mindful of, that banks and the banking industry is going to be part of the solutions out of this crisis. You think about 12 years ago with the global financial crisis, banks were the catalyst of the global financial crisis. Banks needed to be bailed out. You saw what happened, in the US and in Europe. Not so much in Africa and here in Kenya. But banks created what led to the economic travesty of that time. This time it's different. Banks are providing the firewall upon which the economy can recover, because your banks are well capitalized. I think banks are resilient. We have deposits to lend. So we've just got to make a trade-off between giving up a bit of shareholder return to make sure that the economy is supported from a lending point of view. Because, in the history of financial crises or economic crises, whenever there's a crisis, share price trades not so much on growth and profits. It's so much on resilience. And I think that word resilience is very important. As a resilient economy will ensure resilient banking. How do we make sure there's a resilient economy? It's not pulling out credit from the market. It's providing credit in the market at the expense of the shareholder. So I think shifting the power of decision making of our balance sheet towards the economy, a little bit away far from the shareholder, confers the long-term relevance of the industry. And I think that's what you continue to see. We're very much in this together.
All right. And quite interesting insights there, Mr. Muthui. And shifting gears, as we anticipate a recovery, a gradual recovery, of course, analysts have said we are not likely to see a kind of a hockey stick growth come 2021. But the economic fundamentals continue to remain a bit shaken. Looking, for instance, level of inflation as a country, our interest rates, and of course our exchange rates have also been very volatile in the last few months. And is it something that worries you when you look at the data? Yeah,
I think financial stability and price stability is the bedrock of any financial market and any economics. I like the financial stability we've seen. Clearly, inflation has been contained. Interest rates have been contained within the tight range. And I think we're seeing stability in those macro factors. That stability is going to be very, very important. And as market players, we must all rally behind making sure that the financial stability is there. I think having said that, I think your point is quite valid that, the economic recovery is unlikely to be a hockey stick. Given the data we see and the models we have in the bank, we're pretty much seeing a U-shaped recovery, where the bottom side of the U may stay elongated for a few quarters, but certainly we'll see some recovery, as we begin to hold back the impact of the medical crisis with the vaccines, that have now been signed off in Europe and in the US. Hopefully at some point they find themselves onto the continent. As we begin to abate the medical crisis, remember that's the only thing holding us from an economic recovery point of view. As we continue to see some of those initiatives and interventions, I think there will be a recovery down the road. What we don't know is how long the bottom part of the U-shaped recovery is going to take. Right. I think anyone who gives you some indicators, I like to say precision, we leave precision to the God, no one has a crystal ball. We must just deal with this quarter in, quarter out. We are clearly on that bottom part of the U-shaped recovery. How long it takes, no one knows. But so long as we continue to do fundamental things, banks continue to lend and underwrite this economy. So long as that continues, and we're in this privileged position to make sure that we don't trade off that for shareholder profits. For as long as we do that, and we must also care about the commercial enterprise, because we have capital from shareholders who need a return. So I think it's going to be a tug the way through the bottom part of the U-shaped recovery. Looking at some parts of next year to see how that looks like. For now, it's very difficult to say whether quarter one or quarter two next year we're going to see an upside.
Interesting. Yeah. And looking at how the markets have performed generally, we did see the NSE 20 share index holding a bit steady compared to when the pandemic struck early in March. Eventually, it's continued to level off. And generally speaking, how sound have been our capital markets? Have we experienced capital flight at any point? And are investors still seeing Kenya as the bright spots in Africa?
Yeah, so I think, when you face a pandemic that is globally pervasive, there's very few opportunities to take capital, It's a savers market. There are limited pockets of opportunity across the globe where you feel, there's space to apply capital for an extraordinary market-beating return. So I think the entire capital markets across the globe have been subdued. Having said that, though, what's different between ourselves and markets like New York, London, or Frankfurt is the fact that this economy is very much intertwined with the banking system and not so much underwritten by capital markets. 85% of the financing that goes through this economy is from banks. That's the ratio of how much financing goes from capital markets in those developed markets I've just talked about. Despite the performance of capital markets, we don't see as much severe impact on the economic side. It's actually strong banking industry that determines the strength of our economy, not so much the capital markets. Of course, what that means then is, therefore, when we go through crises like the global financial crisis, hopefully we don't face another of that nature where banks are challenged. Then economies that are linked to banks tend to suffer much more, and economies that are delinked from banks and financed through issuing debt and equity and those instruments being bought by pension funds, mutual funds, insurance companies, we see those recoveries happening much, much quicker. So our market is not as liquid, from a relative basis when you compare ourselves with Johannesburg, London, or New York, for good reasons. I think there's a natural progression path for development of capital markets. I like the direction that we are taking. I think Kenya continues to remain a bright spot on the continent for investors looking to bring capital into our markets. What I continue to call out for is the need for us to create Nairobi as the hub of financing for the region, the anchor of financial markets for the region. There's a reason why companies in Spain, in Germany raise capital more from London than from Frankfurt and Madrid, because London has created itself as a global financial center for not just Europe, but the entire globe. How might we create a Nairobi financial center that finances companies across the region? And that's something we have to, to just be mindful of and rally behind to make Kenya the anchor of capital markets and the anchor of finance for the region. I think with the, capital markets master plan, we're headed towards that direction. The sophistication of the NSE with derivatives being listed, I think we're headed that direction. Regulation is headed that direction. We have all the support. It's just that the economic fragility cannot allow for faster development of capital markets. And this is just nature of life. It's the time we're in. Otherwise, I think we're headed the right direction over the long term.
All right.
Yeah.
And Moses, looking at the banking sector, we've seen a number of transactions happening around acquisitions,
right,
to mergers,
right,
rebranding,
right.
Of course, Absa being one of them, formerly Barclays Kenya, now into Absa Group. And generally, central bank governor keeps saying that we are overbanked as a country. Of 44 listed banks, commercial banks, against a population of about 45 million people. And eventually the numbers have kept on shrinking. We've seen the latest, of course, transaction that was closed was between Cooperative Bank and Jamii Bora, where they bought them out and rebranded to Kingdom Bank. And there seems to be a lot of interest around consolidation and banks trying to get into strategic partnerships and strategic acquisitions. Is this likely to still play out come next year?
Yeah, I think as matters consolidation and M&A, I think it's a matter of strategy. I think one has to determine what strategy they are pursuing, and then acquisitions and mergers become an enabler to that strategy. We like to say at Absa that we are looking for capabilities and we are looking for scale. There are many ways you could build capabilities and build your market share, which is what people call scale. You could either buy, you could partner, or you could build, organically. Having said that, though, there are three things just I'd like to raise.
Yeah.
One is the fact that banking is going through a tremendous digital revolution. And we believe firmly that that's the price. We have got to keep our eyes on the ball. There's always competition of capital. We apply capital to invest in technology and digitization to gain scale, and therefore also build that capability that I talked about as a matter of strategy, or do we apply that capital to make an acquisition? If there's one thing I've learned the years I worked on Wall Street advising on M&A is that the true value of an acquisition is not when you pay. Anyone can run desktop valuations and pay a price for an asset. The true value of M&A is when you either integrate it or after you buy it, how you run it. That's where the true value really comes in. And for us, we strongly believe that we need to apply our capital towards investing in new technologies to pursue scale and to build capabilities as the enabler of our strategy. The second thing is the fact that the fallout from the COVID crisis has meant that asset prices are cheap. But the other side of that argument is perhaps is a function of the quality of assets. So therefore, one has to be mindful, and I think different boards are making different decisions on that trade-off. Is the cheaper price that makes the decision, or do we care about quality, and where do you strike the balance to make the right decision for the organizations? And different people are taking different routes here. As Absa, not just in Kenya, but as Absa Group, we do not have a strategy of buying weak assets. We like buying strong assets. It's a function of not just the price, but also the quality, and we'll be very mindful of that. The last thing I would say is that domestic economies need strong national champions. It's unlikely that a Nigerian bank will be the largest in Kenya, or a Nigerian bank will be the largest in South Africa, or a South African bank will be largest in Nigeria. National champions will naturally emerge from their positions of strength. So I think in-market consolidation to pursue that market leadership and national championship in banking is something that I think has merit from where I sit. I think cross-border acquisitions, one has to ask the question, What are you looking for in those markets you're going into? Absa Group is in Kenya. We have 2 banks in Tanzania. We have a sizable bank in Uganda. Once you consolidate these banks into one, we are the 2nd largest bank in East Africa. So we do not need to pursue cross-border acquisitions, particularly in East Africa, to build scale. We believe we have the position to do that. So I think in a nutshell, Abi, I think it's a matter of strategy. Different people will take different directions. I think, market consolidation is really an ingredient of an evolving and transitioning market. I think is the right thing to happen, particularly in Kenya. But every bank will make its own strategy. Our balance sheet grew by 20% in 2018, 15% in 2019, double digit in Q1 2020. So we were gaining market share without acquisitions. And we like that trajectory.
All right. Yeah. And as we wrap it up, Moses, Absa has had the tagline of reaching out to the high end. And clearly, as you've put it, there's the changing consumer needs. There's the race for the small businesses. What's going to redefine Absa's strategy moving forward? And do you feel you've been able to penetrate into areas you'd never imagined? And how will this play out come next year? Yeah.
So I think, first of all, with our transition, we concluded one of the most complicated and most complex separation project in the history of financial services industry. We did the largest data migration onto the continent. We rebranded our entire real estate. For 6 months to the end of the rebranding process or the end of the transition program, there wasn't a single weekend that was not involving a significant change in our systems. We changed about 91 systems. So the complexity of the transition was actually behind the closed doors, right? But the paradox is, consumers out there care less about what's behind the closed doors, even though every single weekend, all our runways were completely occupied, landing new systems and new capabilities and decoupling from our former parent safely and soundly. That's successfully behind us, and we feel very proud on what the institution has been able to achieve. I think the fundamental question worth asking is then what next? What really matters? And for us as Absa, the strategy is fairly straightforward. We believe we retain the best of our history. We still have global presence in London and New York. We are part of a strong, stable, and solid Pan-African financial services group with $100 billion of assets, which is almost larger than the entire banking industry in Kenya, with sizable capital, very solid and very committed onto the continent. So the best of our history remains. Global connectivity, strength and stability, and a renowned brand. The game changer is going to be what we didn't have before that we now have, which is local relevance. Making sure that what we do every day is relevant to the local market, closer to the customer, closer to the consumer. And the 2 big bets for us there are business banking, which is SME, part of that business banking space, and digital finance. We believe these are the 2 anchors that we can build on our base strength. And our base strength has been corporate and investment banking and retail banking. We have the market-leading corporate and investment bank and a very solid retail business, which is number 3, traditional bank, number 3 in the market. So we believe the base continues to be what it is. We have the opportunity now to go after these new areas of business banking and the SME market and digital finance much, much more aggressively because our risk philosophy has changed. We don't have to go to London to get a decision to build a proposition like Timiza. Those are locally made decisions because the market calls for that. And therefore, we can only see an upside. We think, the best times of this bank are ahead of us. The market opportunity is there. There'll be cyclical challenges like what we are going through now, as an economy. But we've retained the best of our history. And we've built something we didn't have, which is local relevance. And our business banking is growing double digit, despite the pandemic. And we're likely to continue to build that side of the business.
All right. Yeah. Indeed, quite a strong finish there. Many thanks for speaking to us, Mr. Moses Muthui, the country director in charge of strategy at Absa, just giving us the lowdown when it comes to how the banking sector has performed in 2020 and his views on what to expect in the coming years. Well, that's why we bring it to a close, and we thank you for your valid company and looking forward to seeing you into the new year. And remember to keep safe and remember always to social distance. Well, for me and the entire team, we say bye-bye for now. See you next time.